I'm extremely pleased to have the opportunity to come today. When Paige called me, I have been passing up all speaking engagements because, very honestly, since I don't have to speak anymore and since I don't have to go anywhere I don't want to go, I've been gardening and looking after a little law practice and a little consulting practice in Washington, and spending a lot of time with my only grandchild, who is now 8 months old. But this is an interesting group of people. From what Paige and Tom had told me, they're all Democrats. And having served 16 years in the Congress as a Democrat, I felt some loyalty to come back and talk with you. And then I saw Kelly McCutcheon on the staff, and I know his father, Joe Kay, and I said, well, I didn't realize Joe Kay had left Buchanan and become a conservative Democrat. Thank you for inviting me. I want to talk for a few moments about taxes and then let you have an opportunity to ask whatever questions you desire. I want you to know that in my new life, I'm doing much better. I now make my own plane reservations. After 16 years, that is quite an accomplishment. You know, in Washington, your staff does all of these things for you, and suddenly you're thrown out into the real world, and you have to do all of your calling, make your reservations, cancel, and reschedule. I am doing that quite well. I am also in modern technology, I'm doing better. And the fax machine, I can now receive. And I'm learning all of those things, and it is quite a new experience. I want to spend my time talking really about three areas of the tax. What is happening right now in the bill that is before the Congress, the miscellaneous tax bill, which is always an interesting subject, and then what is down the road as far as the comprehensive overhaul of the tax code. I used to offer an amendment occasionally in committee. I served all of my 16 years in the Congress on the Ways and Means Committee, and I used to offer an amendment occasionally that would simply say that we could not change the tax code except on leap year, where at least we would have 3 years of stability. I did this primarily for the business community, just to try to raise the fact that it is very difficult for the business community, and has been for the last 2 decades, to keep up with the tremendous changes that take place in the tax code. This is true in all areas, but more probably it is true in the field of pensions and that part of the tax code that drive people absolutely up the wall. But before I talk about the flat rates and the flatter rates and all of the consumptions taxes and the value-added taxes, I want to point out something that the Durants, the historians who have spent their lives, husband and wife, in studying history and writing about it, in writing their volume entitled The Lessons of History, and if you've never read this, I recommend it to you, it's a short volume, concluded that the concentration of wealth is natural and inevitable, and is periodically alleviated by violent or peaceable partial redistribution. They report that in 594 BC, in Athens, the disparity of fortune between the rich and the poor had reached its height, so that the city was in a dangerous condition. The poor was talking of violent revolt, the rich angry at the challenge to their property, prepared to defend their property and themselves by force. Fortunately, some good sense prevailed when a business person by the name of Solon was elected as the leader of Athens at that time, And he did a lot of things. He ended imprisonment for debt. He had to devalue the dollar. But he did something else. He established a graduated income tax, where the higher income paid at a rate of 12 times that of the lower income. So the modern day graduated income tax was started by either a conservative Democrat or an aristocratic Republican almost 600 years ago, almost 600 years before the birth of Christ. I point that out simply to tell you, really, that the graduated income tax has been around a long time. It is nothing new. 600 years before Christ they were doing it. And even if we have a flat rate tax, or if we have a consumption tax, we're going to find some graduation in the rates. And I think that this is something that we ought to put out on the table up front so that we all understand that we will not have one rate, which is sort of a common belief with a lot of people, that we will not have one rate for everyone without any deductions up front, which really make a flat tax, a graduated tax. Now, having said that, I think that we have the greatest opportunity in the last 2 decades to make some significant inroads into simplifying, making more fair the existing tax code. I think that it is healthy to move in the direction of a flat tax, so-called flat tax, or a flatter tax, if you will, because today, if we lose confidence as a people in the tax code, which I submit that we have, then you have the seeds of destruction, and you have the seeds of real difficulty between the rich and the poor, both of whom feel that they are being violated, and we could see the unraveling of a nation. I want to come back to that as I discuss the flat tax proposal that is on the table, but before I get there, let me start with the budget resolution. Let me start with first things first. We have adopted a budget resolution, which is one of the most meaningful budget resolutions as far as deficit reduction that we've seen in some time. This budget resolution provides for a $270 billion reduction, for instance, in Medicare over the next 7 years. To give some idea of the size of this, the largest reduction in the increase in expenditures of Medicare that we have had in the past has been one of $76 billion reduction in the increase over a 5-year period. We have to, now that the budget resolution has passed, the Congress has to grapple with how to reduce the Medicare increase in expenditures over the next 7 years by $270 billion. That can be done, although I must say that I fear that what will happen is that we will backload all of the cuts during that 7-year period of time. And what I don't want to see happen, which I am fearful may happen, is that the Congress will say, well, we will cut that $270 billion by giving people options that you can have either managed care, or you can have your existing care, or you can have this, or you can have that. And then CBO will say that will not raise the $270 billion, or we cannot certify, which they must certify. And the Congress will take the easy way out and say, well, that is what we're going to do to save the $270 billion, but we will add a proviso that if it does not reach $270 billion, the executive branch shall direct HICFA to make the cuts up to $270 billion. Now, what that does is simply this. First of all, Congress has evaded its duty and responsibility of making the cuts that they've passed in the budget resolution. Second of all, it gives discretion only to the executive branch in HICFA to direct where the cuts are to be made, and they may not be made in the best place. I bring this up simply because that $270 billion has a great deal to do with whether or not we're able to get tax cuts this year that are now on the board. Hopefully, Congress will accept the responsibility to enact that which it passed in its budget resolution and take care of the $270 billion over the next 7 years in a straightforward way. Otherwise, we're back into the old game. Second of all, the budget resolution, both of the House and the Senate, while different in amounts, call for a tax cut in two primary areas. First, a child care credit for dependents, $500 for minor children, plus capital gains cut. All of you know that through the years, I shepherded through the Congress 2 capital gains cuts. I've always been a champion of that. I believed then, as I believe now, that the best thing that we can do for the economy is to have a low capital gains rate. I think it is an incentive not only for one particular segment of business, but across the board. I think that a lower capital gains rate unlocks assets that are locked up simply because of the high tax rates. And as you recall, in the 91 and the late 80s, both of the bills that I was able to get through the House, both of those died in the Senate. And I think my Democratic colleagues, of all of the things that they have done that I disagree with, I think that their opposition to the reduction in the capital gains tax rates is a very foolish position as far as the country is concerned. I can remember as a young staffer in Washington right out of law school when John Kennedy pushed through a capital gains reduction, capital gains rate reduction in the early 60s. And I kept reminding my colleagues in the House as I headed up the so-called gang of 6 on the Ways and Means Committee from the Democratic side that passed the tax reduction by 1 vote, that this was something that we were making a terrible mistake on for the country. It may be good politically in the short run, but for the nation, it is not good to have a tax rate on capital expenditures as high as it is today, which is the 28%. If you look back through the economic history, one will find that when we had a tax rate, capital gains tax rate, of 19-20%, we did extremely better economically than we did over those times that we had a higher rate. During the last tax bill, as you know, the only thing that we could get was a reduction from the top ordinary tax rate down to 28% where it is today. I think we have a great chance this time. It has already passed the House. The Speaker did a tremendous job in shepherding this through and keeping it intact. There is a potential problem with the reduction from the Senate side in the overall revenues figure, that you might find a trade-off between this and the child dependent, the $500 per child that is in there. There's about 80 or 90 young conservative Republicans and Democrats who are insisting that that not be reduced at all, even though the Senate has reduced by $100 billion the overall cost. And there is a danger that it could come out of capital gains. The existing proposal takes ordinary tax rates for the individual down to 19.5, roughly 20%. For corporate capital gains, it is 25%. I would anticipate that we will see enacted this year and signed into law some compromise tax bill that will have a capital gains cut together with a child credit as well, probably less than the $500. Second thing that's coming up this year is the so-called miscellaneous tax bills, and I've brought these. The Joint Committee on Taxation has just put out all of the bills that Bill Archer, Chairman Archer, is now hearing, and these are just the miscellaneous proposals, about several hundred of them, covering every part of the code. Let me tell you, I found some of these in here that I introduced before I left, and I've been gone 3 years. I hope they pass them this year. But really what has happened is that there are a lot of good proposals on the table that are now before Chairman Archer. But like previous years, every tax bill has been revenue driven. Because of the scarcity of funds, the rules of the House that are now in effect, as they were in the past, is simply this, that you cannot pass a tax provision that costs money unless you pay for it. These, Chairman Archer told me last week that there are probably about $3 billion in revenue in small bills that will be adopted this year, including the extenders. And the extenders are basically the R&D tax credit, which is expiring, the low-income housing tax credit, which is expiring, the targeted jobs tax credit, which may or may not be renewed, and 2 or 3 others in a costing a lesser amount, which are included in the miscellaneous tax bill. I expect this to come up during the latter part of August, be acted upon in September, and those extenders should be adopted. And I would think some of the more targeted provisions that do not cost a great deal of money will be adopted as well. So that is the second portion of tax legislation that will be adopted. Now, with the appointment of the Jack Kemp Committee to study the tax code, and he is now holding hearings around the country. The last of the hearings will be in Washington, looking at our entire tax code. That is extremely healthy, and I think that while we will not see anything this year, and I would not anticipate that we would see anything next year from the standpoint of being enacted, I think that this is the beginning of a reform of the tax code, a comprehensive reform that is extremely vital. The areas and the ones that have the most support are the following. The value-added tax, proposed value-added tax, and all of these are designed to replace the existing income tax. As you know, probably Canada and the United States are the 2 major countries that are dependent primarily upon income-based taxes. Japan is as well, but theirs is primarily in the corporate field rather than in the individual field. Whereas the rest of the countries in the Western world are dependent more on consumption-oriented taxes, where the base is consumption rather than income. But we have always had the greatest amount of our income from income tax. So whatever we do, if we come away from that, it is going to be a tremendous change, and we'll need some transitional relief, particularly on the business side. But one of the things that the Congress is going to look at and the Commission is looking at is value-added taxes. The plus side of a value-added tax to replace the income tax is that you can make this rebated at the border so that you enhance your domestic production. You can charge the value-added tax at the border on imports to make it equal to what domestic industry is paying, so it would help in the export market. The downside is that it would be extremely complicated to get it into being, because what you really do is to tax the increase in the value along the chain of the production of products or services at each stage. And most of the countries that have a value-added tax, and all of them in Western Europe do, I believe. Japan just adopted one a couple of years ago, a 3% value-added tax. But this would be extremely complicated. I do not think this is going to happen, but it is one of the areas that we're looking at. Second is the flat tax, which probably has more support than any other proposal. Dick Armey, who is the majority leader, together with a host of other members, have proposed a flat tax. This is very attractive. I want to warn everybody from having sat on the committee, though, that if you're thinking that this is the panacea, it is not a panacea. A flat tax is attractive simply because we think it appears to be fair, more fair than the existing code, certainly. And it sounds good because of the simplicity. But most of the complications in the tax code have nothing to do with the generation of taxes. Most of the complexities in the tax code have to do with deductions that reduce your taxes, whether it be charitable contributions or mortgage interest deductions, medical, whatever those become extremely complex. So, like in 1986, when reform came into vogue, and a lot of deductions were done away with, that, in effect, increased a lot of people's taxes in the higher incomes in particular. So it is not a panacea, but it is a step in the right direction, because I think that we can get to a flatter tax, if you will, such as Army is proposing, which would be much better because it is consumption-oriented, different than our present income tax, and it is consumption-oriented because of the fact that he proposes to set aside the first $12,000 to $20,000, depending upon how much revenue it will cost, as a amount that is not taxable. So, in effect, what you have is, if you have $20,000 set aside, and you have a flat rate, it is really a graduated rate on someone making $60,000 or $70,000 or $80,000. So all of these are somewhat graduated. The USA Tax Act, the non-dominici, probably is the one that is being looked at more in depth today. It, in effect, also is consumption-based. It basically exempts anything that you invest in savings or in permanent investment from being taxed, with the exception of land, I believe. It does not include. But this will be one of the serious proposals that the Congress will look at. Bill Archer, chairman of the Ways and Means Committee, has always been somewhat favorable toward a National Retail Sales Act. He has not yet introduced his bill. I do not know that he will, but certainly that will be on the table. Once again, that is a consumption-based tax. Gephardt has come out with his flat rate, and the existing rates today are 15%, 28%, 31%, 36%, and 39.6%. his tax bill, his flat rate tax bill would have a 10%, 20%, 25%, 30%, and 33%. And he would keep a couple of the deductions that we have today. Mortgage interest, I believe, is one of those. I want to end by saying, because I'm covering too much territory, let me say that I think what will ultimately be adopted will be some form of a flat tax. That is probably 3 years down the road, that it will not be everything that you envision. It will certainly not be a panacea. There are a lot of complications with a flat tax from the business standpoint. We do not take in much money today from the corporate sector as we did many years ago. Less than 10% of our income is from the corporate sector today. That has been reduced over a number of years. But when you try to transition the existing code into the business sector, you will have a world of problems that can be dealt with, but they're real problems. For instance, what base do you use? For instance, what happens to the credits that you've built up? You know, with the AMT, with the minimum tax that some capital-intensive industries have had to pay, borrow money to pay, which is wrong, they have credits for the future when they do make money. Hopefully the AMT, incidentally, will be a part of the relief granted this year and with the capital gains proposal. But what do you do with those credits? Do you permit them to carry them on? What about timber industry? How is their existing timber based? What basis do you use for that? A world of problems from that standpoint. I want to end by saying that generally, here is what we ought to look for, or the Congress ought to look for when they examine the tax code. First, does the proposed tax system promote or hinder economic efficiency? That is, to what extent does the tax system distort taxpayer behavior? Does the tax system create a bias against the domestic production of goods and services? And to what extent does it promote economic growth? Secondly, is it fair? Is the tax system fair? Does the tax system treat similarly situated individuals the same? Thirdly, is the tax system simple? Is it costly for taxpayers to determine their tax liability and file their taxes? And lastly, can the tax system be easily administered by the government, and can it induce compliance by all individuals? Is enforcement costly? And most important, is the burden of taxation within the realm of acceptability of the American people? If we answer all of those properly in developing a tax code, we can make great progress in the next 3 or 4 years, regardless of who is in the executive office, and regardless of who is in the Congress. If the members of the Congress and the President, whomever that may be, will seriously answer those questions properly, forget the politics, and let's do what is good for the American people. Thank you so much for letting me speak to you this morning. I'll take any questions. I know the time is limited, but so you'll have to tell me when to quit. Any questions? Yes, sir.
I appreciated your reference to what it's like to be away from the perks of being in Congress. That intrigues me. We admire Harry Truman for presumably being able to go back to independence and walk around the town and so forth. You mentioned the airline reservations. What else is hardest to come away from with all the headiness of public office?
To be perfectly honest with you, I was saying that in a humorous way. There has not been any great loss from the standpoint of perks. Probably probably the loss of staff to do things, obviously, is something that if you want to write a speech or you want to, that type of thing. But perks, I think, have been really over-exaggerated in the press. They're not that important. They're not that important to members.
We've gone on record as being the national sales tax is abolishing the IRS.
Yes.
Rationale figures it's 6 billion man-hours to process the claims. If you go with the national sales tax, you eliminate basically the need for the IRS other than dealing with 50 entities in the 50 states. If you keep a flat tax, you still have the IRS in place. You still have the forms process. The idea is to reduce the effect of government. You can't elaborate the sales tax more. I see the flat tax is really quite the evolutionary process. I'd like to hear you elaborate more about the sales tax.
Well, the national sales tax is very attractive from the standpoint, as you indicate, that most of the 50 states, I think all of them maybe except one, have state sales tax, and it is proposed by many people that the federal government piggyback onto the state systems, letting them actually collect the federal tax and remit it to the federal government. And from that standpoint, I think there would be a great deal of efficiency that would meet one of the criteria that I indicated. You could take care of a lot of the lack of the progressive nature of the tax by doing several things, obviously, by having a refundable tax credit of some kind for the first X number of dollars that a family spends a year. But I do not at this point see a great groundswell for a national retail tax in the Congress. I would tell you that you have one strong ally who happens to be chairman of the Ways and Means Committee. Bill Archer is a very able fellow, and he has always felt that some form of tax in the field of the direction that you want to go is the best. I don't know how high it would be. Here is what you run into. You have to make a decision. Can we get by with, do we have to have the same amount of revenue that the existing system is producing? If you say yes to that, and most people probably would say yes because of the deficits at the present time, then you have to design the rate of the tax, whether it be a national retail sales tax or a flat rate tax, to make that produce that amount of income. In the early 80s, there was a flat tax offered as a substitute, I guess, to the 86 tax bill. Not a great deal of thought had been given to it, and when it was offered, the member offering it, Dick Schultz, I believe, said in whatever rate is necessary to bring in the same amount of money. And the Joint Tax Committee at that time in the Ways and Means Committee indicated that that would entail in excess of 24%. And suddenly you would have middle income getting huge tax increases, which no one was willing to vote for at the time. Since that time, there's been more thought given to the proposal and making sure that the first part was an exclusion. That will have a hard time selling, I can tell you.
What do you see about some of the hidden taxes like the airline tax, inheritance tax, capital gains officer? So there's a lot of hidden taxes, and again, corporations pass those taxes on to the
Sure, no question about that.
We don't look at those taxes, and again, I think that Bill Archer put on the 15% or whatever the number is. I think if we look at a lot of that hidden tax, we'll probably drop it. Start off gradually.
Well, I think there is, you have a strong ally in Bill Archer, and I have a great deal of confidence in his ability. But I think that the flat tax based upon income that Army is proposing has the better chance at this time. And it's an uphill battle. Any further questions?
Do you care to
On reapportionment, well, I had not intended to, but I saw Newt Gingrich a few minutes ago, just spoke to him, and I asked him if he were coming over here to talk to me about reapportionment. I thought maybe he was thinking that I was going to be one of his constituents. I don't really know what's going to happen there. I would think long term, not short term, but long term, the state will probably be better off with letting the legislature reapportion based upon some geographic cohesion. For instance, I think the mountain counties, everyone, you know, politics is local. I think they all stay together. And I think that suburban areas have a common interest. Inner city has a common interest, and you should not divide all these things in little pockets, as has been done in the past. I think that the black community will be better off having members, whether they be a white representative or a black representative, with 25% minority in a district than they do today, simply because a member has to respond to his constituency. And long term, I think that a member responds if you have a 20% minority. I had 3%. Of course, you know, unless you move me up into North Carolina or some other place like that, you can't. I was bounded by South Carolina, North Carolina, Tennessee, and Atlanta. When I went to Congress, I had all of Gwinnett County. In 1977, the entire county plus 21 other counties. And as Gwinnett became more Republican, I lost a little bit every reapportionment because the legislature didn't think I could handle all those suburban Republicans. But I got along with them pretty well, to be honest with you. There's not that much difference. You know, I've been a Democrat all my life, but I've never been fanatical about it.